Hello, and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Ann Azevedo, and this is our Wednesday episode where we hone in on a trend in the startup world and dive deep. Today, we're talking to Flourish Ventures co-founders Tilman Ehrbeck, Emmalyn and Arjuna Costa. We're going to be talking about how the firm's investment themes have evolved in the past 5 years, what trends they're most excited about today, and I'd also like to get their opinion on some of the current events and M&A deals in fintech. Thank you all so much for being here. It's great to see you and talk to you again.
Thanks so much for having us.
It's a pleasure.
Yeah. So the three of you founded Flourish Ventures in 2019. And now you have, as a firm, $850 million under management. You invest all over the world, and you back fintech startups exclusively. Is that correct?
That is correct.
Yes. All right. So you invest in the U.S., across Africa, Asia, and Latin America. Also, you're an evergreen firm, so that means your investing is open-ended.
That's also true. Yep.
Yeah, that's right. Last time we talked, Tilman, you were telling me that you felt like that gives you a little bit less pressure as a firm compared to some of the other outfits.
Yeah. We do believe that we are not driven by the artificial time constraint that a typical 10-year fund structure would have. We don't have to deploy and we don't have to exit just based on those timelines. We can do what's right for the founders that we support and invest behind.
Well, over the years, you have invested in a number of companies, I think over 70, including digital bank Chime, Brazilian neobank Neon, embedded finance startup Unit, and African payments infrastructure company Flutterwave. And I last caught up with you last fall when you announced a new $350 million fund. So what have been some of your notable investments since then? And can you also talk to me about some of your higher profile exits overall as a firm?
Maybe I'll touch upon some of the more recent investments we've made. We've really, first of all, just been so impressed with the speed and the ongoing innovation in fintech. I know that the markets don't always dictate whether innovation is happening. I think as a longtime fintech fund, very committed to this sector and its opportunity for transformation, we continue to be really excited about some of the entrepreneurs that are coming to market and the types of technology that continues to surface. One thing we spoke with you early on was around trying to look at different intersections. So the intersection of climate and fintech, the intersection of healthcare and fintech. We also continue to double down and look at areas in infrastructure, which we're very deep in already, whether that's in payments, insurance, banking, data. Some of the companies that we've invested in that have been announced, at least, one of which is in the fraud space, an area that we know quite well in compliance, like we're in Alloy and Hummingbird and TrueBiz and others. But a company we invested in was a company called Spade. Mm-hmm. They're doing a lot on the pre-authorization, credit card authorization fraud. Been a really incredible team, but it kind of dovetails very nicely in the pre-existing sector that we've looked at. We have not announced, but we've closed some deals in the intersection, as I mentioned, of climate and fintech, as well as healthcare from a vertical SaaS embedding fintech services, among others. But those have been a couple. We've also done some in the compliance area around automating the licenses that are required by financial services and using AI and workflow to help really streamline and automate that process more holistically. Another company we have not announced yet, but I have invested in. So a couple of them certainly in the US that we're quite excited about.
In terms of exits, Marianne, we are a bit too young as a firm to have many of those, but we did exit 2 companies that were notable. So in the US, we had made an early investment in the wealth management space, sort of our version of the robo-advisor. And the insight there was that the first generation of robo-advisors focused on the young who are digitally savvy, but they don't have any assets. Whereas the assets are really with the 55 and older crowd in the US, 80% they own. And when you reach that age, you have an interesting decumulation problem, right? You need to plan for retirement. When do you draw down your 401k? Should you wait? When to start drawing down Social Security? You might have still some defined benefit from an early employment in your career. So there was a company we had invested in, United Income, that would take all this information and optimize for the retiree or soon to retired person. And that company was acquired by Capital One. So that was an early exit we had. Frankly, a little earlier than we had hoped, but we were, of course, still happy.
Yes, of course.
Another one would have been Grab Financial. So that was in Southeast Asia, Grab, the ride-hailing and food delivery company. They had a very interesting embedded finance play to provide working capital to their drivers, insurance to also their drivers, but also to the ride-hailers. And so we had invested in the financial services subsidiary because we strongly felt that that was an interesting play. And then as you followed probably, they filed for a SPAC and remerged the financial services subsidiary with a holding company. And so we swapped shares and then we exited via the SPAC. So those were two of our early notable exits. We have quite a few companies that are gearing up and will be ready when the IPO window reopens. So as a fund, we are pretty excited about that outlook.
Exciting. Yeah. Well, looking forward to hearing more about that when the time comes. Well, obviously, fintech is a sector that, as we all know, has had its ups and downs over the past few years. After the pandemic, things were booming, 2020, 2021. Investors couldn't get enough, right? Fundraise after fundraise in the fintech space. I believe it was 2021 where fintech made up 1/5 of all venture capital investments, which is nuts. Then there was a slowdown in the venture world as a whole. And as part of that, of course, fintech has seen a decline in funding, just as many other major sectors. How has your investment thesis evolved since your early days and considering this investment slowdown? And also, what role is AI playing now when you're evaluating new investments?
I think the benefit of being a pure fintech-focused fund is you're really building deep conviction and much longer-term horizons. And having been an investor for over 23 years, I've just learned that these cycles extend well beyond the market cycles. And so really thinking through from a thesis-driven, which is very much the way our fund operates. What do we think it needs to be transformed? What are transformational opportunities in financial services? And how can we pull those building blocks together early and start making bets? And I think a number of our theses have played out over time, and that's really been our approach to taking those investment risks. But I don't think it's shifted materially how we've approached the market. I think we've leaned in. In fact, if anything, some of the tourist investors have left. And I think, quite frankly, it brings a breadth of opportunity. I think it level sets, it aligns incentives for entrepreneurs to be able to build the business at the speed with which it makes sense and to raise capital at the speed with which it's appropriate. And I think we've been real beneficiaries of that and taking that approach. But in terms of our thesis or shift, if anything, I think one thing that's probably noteworthy is certainly we started early on in challenger banks and digital banks. We have 9 globally, right? So we've taken that learning in the US and been able, starting with Chime, and been able to really extend that learning on a more global basis. There are many themes for which that applies in our fund, and that's the beauty of being a global fund. And we've certainly amassed domain expertise in the direct-to-consumer models along that dimension. But we've also gone very deep, as you can imagine, beginning with Flutterwave in Africa, but all the way through the US, looking at the infrastructure, the underlying infrastructure that needs to be modernized as well, and how embedded finance takes a huge role, which is why that's been an area that across the regions we've developed. And I think, but we've had the benefit of really understanding both dimensions quite well, both direct-to-consumer opportunities as well as the infrastructure side.
Yeah, infrastructure has proven to be pretty resilient, I think, throughout all of this.
Yeah, maybe 2 quick reactions, and then I would be curious to how Arjuna feels about this. So I would first say we don't feel like we are down from 2021. We are saying 2021, that was just very, very unusual. We are actually back to very sane levels.
Yeah, thankfully.
And during 2021, it was tough to resist. We too might have fallen victim to FOMO once or twice, but by and large, we tried to stay really, really disciplined because we knew that 21, 22 was, in the first half of 22, was the exception for fintech, not the rule.
Right.
That's maybe one sort of framing point. And then in terms of thesis development, we came to the space from first principles. Arguably, as we started, before we got together and launched Flourish, we came to this before the term fintech was even coined, from first principles. We knew that there was so much opportunity with tech-led innovation to both dramatically improve the functioning of the financial system and to serve people much, much, much better. And that conviction has remained. And of course, what is feasible and what is super exciting changes over time. So the first couple of years was very much this digitization of financial silos, right? Challenger banks, digital credit, insurtech, wealth tech, etc. And it really evolved into embedded finance with 2 components. On one hand, platforms or vertical SaaS players who reach their customers, are deeply embedded in their activity, and therefore have low customer acquisition, non-financial players, and therefore have high customer engagement, low customer acquisition costs, generate data that has predictive power. So that was one bundle of investments we made. And they need to connect with the financial system and regulated balance sheets. So we realized we need really an API-based, cloud-based, very modern B2B fintech infrastructure. And we have invested quite a bit in that as well, across the US and in the emerging markets.
Yeah, speaking of emerging markets, well, I've been watching LATAM closely for a while. I know Africa has seen a bump in interest in recent years. What would you say are some of the hotter markets for you all now, and why?
So maybe I'll jump in here, Marianne. We've really found a lot of great businesses coming out of Latin America. If you look at Mexico and Brazil in particular over the last couple of years, we've seen both a higher caliber entrepreneur as well as real strength in the macroeconomic conditions. Mexico has benefited from a lot of the nearshoring, so you're seeing really robust small business growth, high employment levels, increasing consumption power, and that's leading to just nice tailwinds in the market. Brazil as well. And one of the things we're seeing that's really heartening is we're backing entrepreneurs for the second time within our own portfolio.
Mm-hmm.
So you're seeing company founders go through that cycle, exit, and start again.
Oh, wow. Even within just 5 years, that's impressive.
Yes. So that maturity of founders and the level of thought, diligence they bring to the second time around journey is really impressive to see.
Mm-hmm.
You know, we've expected that in Silicon Valley and New York for a long time. To start to see that happen in markets like Indonesia, India, Brazil, and Mexico is very heartening because it tells us that we've done something right, that we're getting these repeat entrepreneurs coming back to us.
That's interesting.
To be honest, if I were to just address some of the other regions, Africa has been a little challenging for the last couple of years, just from a macro perspective.
Mm-hmm.
Some of the bigger markets like Nigeria and Egypt have just been struggling with internal macroeconomic challenges, high inflation, increase in food costs, currencies losing value. So given we have this global purview, we're very thesis driven and we can be very disciplined because there's no pressure to deploy. We're constantly calibrating where we lean in particular markets, and then where we can take a little bit of a wait and see approach,
Mm-hmm.
or look for investment themes that are less direct to consumer, country specific investments, but regional and global investments being built out of these markets.
Yeah, that's actually fascinating. I mean, I guess every market's going to have its own set of challenges, right? Based on the economic environment, just the different unique needs of the populations when it comes to financial services. But I would agree that I have seen an increase in investments in Mexico for sure. It's definitely growing a lot there. I mean, Brazil has long since been kind of the powerhouse in Latin America, but seeing more and more interesting startups and more money flowing into Mexico for sure. One of the things that I asked about earlier, but I want to touch back on, just curious about, of course, AI. I mean, I'll be honest with you. I'm a little tired of hearing AI all the time. And, you know, people can say what they want to say, but it's just become a little too much, in my opinion, like everything, AI. Okay. So do you feel like when you're getting pitched from startups, are you seeing more AI in their pitch decks or in their pitches? And how much of a role is that playing in your consideration? Because it feels like a lot of startups, they believe they have to incorporate AI or say that they're incorporating AI somehow in order to be relevant or investment worthy.
Like they used to have to say they were blockchain or crypto, right?
Right. And I'm not trying to say that AI is not worth funding, or there aren't very legitimate companies out there that are using AI in really great use cases or great ways. But just wondering how much of it is playing into your consideration when you're reviewing potential investments and just what you think of it overall.
You know, I can start us off real quick to say first, AI in the broader sense, machine learning, we have invested against for a long, long time. In the entire data-driven, alternative data-driven credit space, for example, in parametric insurance, there's a lot of areas where traditional AI machine learning was very prevalent already. Gen AI is a new phenomenon, obviously, as we all know. It seems to be a great productivity tool that we should all be using. It's probably not precise enough for compliance and other purposes, because by design, it's sort of only 97% accurate. There's a random dimension to it, which is why we get different answers when we type in the same question. So as a productivity tool, great. Standalone in financial services, we honestly haven't seen so much yet. M for the US, Arjuna for emerging markets. What's your sense?
Yeah, I would say that it's an important technology. All of our companies are using it, all the large incumbents. They'd be remiss in not integrating that. And that's going to be an incredible backbone for how financial services operates going forward, both at the infrastructure level as well as the direct-to-consumer opportunities. I would be surprised if we would bet and pick and seek a company that's specific AI fintech on its own accord as a standalone opportunity. It would be something they'd embed in as a core part of their offering to help streamline certain processes. In fact, the more it's relying on AI, the more you'd have to ask yourself, well, what's your defensibility then? Because anyone can access those technologies. So what is the underlying data set that is unique and defensible that allows you to be successful, right? Which is why verticalized plays are probably getting more success in how they're using AI within the financial services ecosystem. But again, I would say that until we can figure out ways where real technology like PII level data can be safely used with some of these algorithms in a way that doesn't promote or potentially respond with fraud or otherwise, it's going to be very difficult to see a true pure play on its own. But we will very much expect to see that, and we will demand and partner deeply with our companies to see how they're integrating them in their core workflow functionality, whether that's front end, consumer services, whether that's more on the automation and report side, workflow automation, which is where we're already starting to see that in spades.
Interesting. Well, I can't talk about a specific deal right now, but I am writing today about a pretty good size M&A transaction in the fintech space. And the week before last, I covered Stripe acquiring a rival startup, Lemon Squeezy. So just wondering, has M&A activity lived up to your expectations? I mean, what are your thoughts on the acquisition route versus pushing for an IPO? I could just say on my end, I think we all were expecting a little bit more M&A last year and this year, but it does feel like it's picking up a little bit these past few months.
Maybe I'll jump in for the US, obviously taking into account the Discover Cap 1, which has truly skewed the numbers disproportionately. This is the most successful and largest quarter we've ever seen in years in terms of that magnitude. But even taking that out, still over the last 4 or 5 quarters, it's still pretty considerable in terms of M&A activity on a volume basis. That being said, a lot of them are larger. You're right. There are kind of strategic, and they're not the type of tuck-ins and Stripe-esque. And even with Chime and Salt Labs, you're not seeing enough of the smaller strategic activity that we would have expected. I think you're going to see more of the tuck-ins, the nice-to-haves, which extends either geographical reach and or additional functionality that's already on the roadmap, has already begun to kind of be tested out. When we think about the investments we're making, we always think of both outcomes. And I think that the expectation is as this activity continues, we're going to start to see a lot more of that M&A activity in conjunction with what we hope to be IPO window opening for fintech as well.
Yeah.
We are starting to see a lot more strategic thinking around how do we start to put the pieces together? Where are there really great companies that we can materially shift our market position, our reach, our roadmap? And we're starting to hear that more so, certainly going into the year.
And maybe a quick emerging markets perspective. We don't have quite the depth in terms of the pool of buyers, right? So when we are building these companies, time to exit tends to be longer.
Right.
What we are seeing from an M&A perspective is some of our portfolio companies starting to become aggregators, getting much more active as acquirers as they build broader horizontal platforms. And once they reach a particular scale, the expectation or the hope is, even if the IPO route is a little ways away, they become very attractive to bigger, dominant international players looking to get a foothold in particular markets. So you are starting to see greater activity, may not be exactly the type that you started to ask us about. Right. So the markets are active. It's we're finding ourselves on the acquirer side as we build out these platforms.
So you're saying like in the emerging markets, you're seeing more of the companies doing the acquiring of like smaller. Are they generally acqui-hires or just smaller acquisitions?
Smaller acquisitions, accelerating product roadmaps through acquisitions, trying to become more vertically integrated as service providers. So beyond the acqui-hire, which tends to happen less, it's very much around a
product
vision for a more robust product. Exactly.
Yeah. Well, the M&A deal that I'm writing about, which I, again, can't say much more about at the moment, does involve an Asian company that is being acquired by a US-based one. So to that point, that's very interesting.
Yeah, market expansion. The other thing really quickly, Marianne, is that we are seeing a big activity around the financial buyers. Mm-hmm. So in the US, the largest M&A that's been happening, probably the top 10 or 12 have been all by financial buyers. So PE is still quite active.
Yeah.
And I think that will continue to be a really active, fruitful opportunity for exits as well.
That's true. That is true. I want to shift gears just briefly on the topic of founders. I know that you all have made some observations around fintech founder well-being. In general, I think there's been discussion about founder well-being and how difficult, how challenging and taxing it can be, especially in the environment that we're in. To be a founder, I've heard of some horror stories about, and not you all, but I'm saying other firms who like pull term sheets at the last minute, things like that, where companies have had to shut down because they were relying on a raise that didn't materialize, things like that. So what are your thoughts on this topic? What are you all doing as a firm to make wellness of founders a priority?
We recognize this early on that we want to back founders on their entrepreneurial journeys, not just this particular investment, because founders bring something unique. We work with a researcher who's come up with this term called creative capital, that entrepreneurs bring something unique that adds to society. And recognizing the challenges that they've been facing, we've really made founder well-being a priority at the firm. What we found in the pandemic was that not just the companies that were struggling were under a lot of pressure, given the large amounts of capital that was flowing to these companies with, one might say, outsized expectations of growth. Even the successful company founders were under a tremendous amount of strain. And so we really sort of started thinking more broadly about how we can elevate this as part of the broader conversation when talking about startups. We've started doing a lot for our own portfolio companies, as well as starting to think about how we will engage with the broader ecosystem of other investors to make supporting the founder throughout the journey a part of how we engage as investors.
What do you mean by support?
Our support takes a variety of forms. Right. So, for example, every year and multiple times a year, we bring our founders together and focus on the leadership journey. These are not conferences in the traditional sense. These are very much focused on thinking about the founder as an individual and a leader and what their own growth looks like and investing in that, and expanding that from just focusing on the founder to thinking about the entire executive team, how they work together, how they find balance, how they work on themselves as leaders, as well as on the KPIs that the company needs to deliver. Beyond that, we have a number of things like founder circles where we facilitate groups of peers who work with each other and talk to each other and rely on each other to work through tough challenges. We bring external support around coaches and executive facilitation. So we've got a number of these types of initiatives in place for our portfolio companies and are now looking to broaden the conversation and see how we can influence other investors to take a similar lens to working with their portfolio companies.
Well, I'd like to look ahead now. What's next in fintech over the next year or year and a half or so? What do you see playing out in this space?
So we had mentioned a couple of sectors that we continue to be quite excited by. And I think that we're actually really on the first or second iteration of infrastructure. There's still so much, whether that's the core banking infrastructure, insurance as we know it today, data, payments, that still needs to be reimagined. I think you're starting to see, particularly on a global basis, not just in the US. So we're still very much making bets and are very excited about what some of that next generation of technology looks like. We're also looking very much at, as we mentioned before, fraud and compliance. And interestingly, where does Gen AI and where do some of these other technologies help facilitate? But where there are continued opportunities, particularly in a world where we have real-time payments, as we think about some of our other geographies with PIX and other infrastructure and open banking, where we might again see opportunities for compliance and fraud and technology being a critical piece of that. Vertical SaaS is one area that we continue to innovate on, and we've made a number of bets, some in a variety of sectors and waste management and healthcare, a variety of different parts of healthcare. We see that opportunity continue in various verticals, particularly serving SMBs and the like. We'd mentioned climate. and healthcare and housing. I think that's not just in the US, but globally. We see a huge opportunity there where the points of convergence afford. And I think we're very much on the cutting edge, and that's still very early. There's a lot more we can do there, particularly across all our markets as an investor group around really making bets that position the advancement of climate and where financial services can play a role. Similarly, the advancement of housing and where financial services play a role, and healthcare as importantly. So those are just some areas that I think we continue to get very excited about. On the broader basis, this idea around financial wellness and mental founder well-being is actually really important to us. I think we're starting to see a whole generation of entrepreneurs coming in, having been investing a long time. Many of these entrepreneurs have never gone through a cycle, run a company through a cycle, seen a correction. Mm-hmm. And we think this is a real opportunity as investors and as partners to really be leaders in defining how that relationship should unfold. And so that's another area that as a firm, we're very excited about and spend a lot of time personally learning about how to be better board members to help facilitate that success long term.
Okay, well, we are just about out of time, but I want to give our listeners an opportunity to connect with you online. Where can they find you?
flourishventures.com. And then we're on LinkedIn. Please follow us. And we look forward to very much staying in touch and keeping the dialogue open and partnering with you.
Awesome. Well, thank you all so much again for joining us on the show. And to our listeners, you can find me on X at Bay Area Writer and Equity on X and Threads at Equity Pod. Talk to you on Friday. Thanks again. Equity is produced by Teresa Loconsolo with editing by Kel. Bryce Durbin is our illustrator, and we'd like to give a big thanks to our audience development team and Henry Pickavett, who manages TechCrunch audio products. Thanks so much for listening, and we'll talk to you next time.